You know, this is one of those weeks where the markets felt a bit like a crowded cafe, lots of noise and no clear theme. Consumer confidence seems to have fallen sharply in the US, while gold tucked away into its usual comfort zone. Crypto tried to steady its breath, and oil wandered sort of aimlessly. And if that left you feeling something was slightly off, don't worry, because the entire market felt equally puzzled.
I saw the same thing when I caught up with a few people in the IFC last week. Everyone started connecting the dots about where the market was heading, and somewhere in the middle, the dots just wandered off.
Honestly, that's exactly why we're here, to bring a little clarity to all of this. This is the weekly pulse by sentiment, and I'm your host, Tina Williams, joined by my co host for today, Kaustub. Every Saturday, we look beyond the headlines to understand how the markets felt that week, what pushed them, what pulled them, and what they quietly revealed about the world that you might have missed. Settle in, because this was a week worth unpacking. Today is Saturday, the 29th of November, 2025. Okay, so let's start where the real shift happened this week. The US Consumer Confidence Index dropped to 88.7, the lowest since April. The Expectations Index slipped into the low 60s. Both Reuters and Al Jazeera pointed out that these levels usually signal early stage recession worries. To add to this, the conference board's Dana Peterson said people sounded slightly more negative this month. That little shift in tone often marks the start of something much larger. It's usually a clear sign that households are bracing for tougher times, with more people expecting their incomes to fall and job prospects to worsen over the next 6 months.
I noticed that too, but not from the charts, honestly. My meetings throughout the week, both in UAE and Saudi, had the same mood showing up in all the conversations. Not fear, not pessimism exactly, just a quiet tightening. People weren't looking for reasons to panic, but they also weren't in a hurry to stretch into new risks. You know, it's that moment right before the room exhales.
Exactly. And that's what made this week so interesting, right? Because while households were becoming cautious, the Fed sounded unusually calm. In the opposite side of the spectrum, JP Morgan reversed their earlier stance and now expects a December rate cut. Goldman Sachs said that a September jobs report may have already sealed this rate cut move. And the futures market priced the chance of a cut at roughly 85%. So households on one side are bracing while policymakers are relaxing.
Interesting. And that split always fascinates me. The public is reacting to the weather right outside the window. The Fed is reacting to the forecast, is what I feel. And the forecast can sometimes look kinder than the sky overhead. Markets usually follow whichever one feels more believable that week. And usually in situations like this, where the market is split, you see people place their belief in something more reliable, like gold.
You are 100% correct. Over the week, gold climbed above $4,100 an ounce, while silver pushed past $52. Those levels reported across market coverages both by Yahoo Finance and Fortune. They weren't really about optimism. They were about protection. The logic here is very simple, right? If policy is shifting towards cuts and the real yields are drifting down, then non yielding assets like gold become more attractive. But if at the same time, consumers think that inflation will still be high, inflation expectations around 4.8%, as US confidence data shows, then gold is still the safe haven for now.
Honestly, even if you looked at the charts this week, it wasn't really a straight line, right? Technical coverage of the metals through the week showed that sellers kept testing support levels and taking profits after sharp rallies. That's the market's way of saying, hey, we like the safety, but we don't fully trust the story yet. It's safe haven demand for sure, but with one eye on the exit.
True. But then let's take a quick look at crypto, shall we? Because it had a very interesting and different story this week. Bitcoin honestly had a very rough month. From an October peak around $126,000, Bitcoin slid to lows near 80,700 in November, a drawdown of almost 29%. Coverage from NordFX and WazirX pointed out to a familiar set of culprits: heavy leverage in the system, forced liquidations as prices fell, and underwhelming inflows into spot ETFs that was supposed to be the institutional bridge into crypto. But then this week, the market found a patch of stability. By November 26th to 27th, reports in the Economic Times and Coindesk had Bitcoin back above $90,000 ahead of the US Thanksgiving holiday, with other major tokens like Ethereum, Solana, XRP, and even Dogecoin also participating in the bounce. Coindesk framed it as a rebound, not a reversal. The downtrend still looms unless Bitcoin can break to make or break resistance near the $98,000 mark and then hold above $100,000. ETF flows remain lukewarm, and the widely watched Fear and Greed Index only managed to get off the floor up from 10 to 20, which is still firmly in fear territory. Just less extreme, I'd say, than the outright panic of earlier in the month.
So then, Tina, it's fair to say that crypto ended the week not exactly in crisis, but not recovery either, right? It seems to be in that in between phase that markets often mistake for safety when in reality it's just exhaustion.
You can't deny that. And that kind of exhaustion was beyond visible when it comes to oil. Brent crude is on track for its fourth consecutive monthly loss. Bloomberg captured it succinctly with a headline that said, "Oil is set for a fourth monthly drop on glut," as trading in WTI resumed after CME outage. Bloomberg Morningstar's wrap on the week highlighted how much attention traders are paying to the Ukraine peace negotiations. The more seriously the market takes the possibility of a deal, the more geopolitical risk premium slips out of the prices. At the same time, US inventory data shows crude stockpiles rising by about 2.8 million barrels, which reinforce the idea that demand isn't exactly roaring. And if we shift to the supply side and look at the OPEC Plus for a moment, according to Reuters, the group is expected to hold its oil policy output steady throughout the first quarter of next year, with meetings scheduled to start on Sunday afternoon. Sources told Reuters that both OPEC and the wider OPEC Plus alliance, including Russia and others, are likely to stick with the current targets rather than risk destabilizing prices any further. That's essentially a signal that producers see the market as fragile and don't really want to add more volatility on top of already weak demand.
You know, this actually reminds me a bit of what we saw around 2015 in the Gulf. Demand never collapsed, but you could feel this gentle tinning in activity as if everyone was waiting for the next cue before committing. This week seems to have a similar texture.
Hey there, Kaustubh here from Paise. While the weekly pulse dives into the biggest shifts in the market mood each week, I wanted to share a quick update with you on something that we're building at Paise. The Sentiment app, powered by Paise, is coming soon to iOS and Android. It tracks the sentiment behind more than 30 key UAE and global macro topics, and it's built for anyone who wants a clearer, more structured read of the market rather than the usual headline clutter. Sentiment uses AI to scan over 100,000 news articles, social posts, and research pieces, curating what actually matters for you and lays out both sides of every story: the bullish drivers, the bearish risks, and the narrative turns worth paying attention to. Join the waitlist now by heading to sentiment.finance. That's SENTIMENT Now back to Tina and the weekly pulse.
With the backdrop set about last week, it's worth looking at how the big asset classes are positioned heading into the coming week, because each of them is now orbiting the same central question: what exactly will the Fed cut mean? Starting with the US Treasuries, the 10-year yield sliding towards 4% mark is the bond market's way of saying it believes in the easing cycle, and the fact that it's about to start. JP Morgan's shift, Goldman Sachs' September seal deadline, and Fed Watch probability all point in the same direction. Policy is moving from higher for longer to we should probably take the edge off right now. But the nuance, as always, lies in the timing and messaging. If Powell even hints that the committee is uncomfortable with the market pricing, you could see yields back up very quickly.
Hmm. But then I don't you think it's fair to say that gold is riding the passenger seat of the bond market right now because of roughly 2.5% gain this week on top of more than 50% gains last year to date seems to reflect a very specific cocktail. Gradually lower yields, persistent anxiety about inflation, and now a clear weakening in household confidence.
Correct? The case for holding some gold here is about not trusting the macro mix. Next week, any sign of hawkish hesitation from the Fed could trigger a round of profit taking. But as long as real yields drift lower, the structural bid underneath gold remains hard to argue with. Oil, by contrast, is entering the week with very little cushion. The market is already leaning bearish, inventories are rising, and demand data seems soft. OPEC Plus can stabilize expectations by keeping output targets unchanged, but they can't really conjure demand out of thin air.
I know. And if Brent starts the week around the low 60s and then breaks below 62, a lot of systematic and technically driven selling could cause a pressure, right? Pushing prices toward prior support zones that traders have in mind, even if they don't really want to talk them out loud. What do you think about crypto, though, Tina? How do you think that will fare next week?
Honestly, Bitcoin and the broader crypto complex are in a different kind of waiting room. They've stabilized off the lows, but the structural damage from the November drawdown is still there. ETF flows haven't meaningfully reversed, and the $98,000 resistance line is doing a lot of heavy psychological lifting. If the Fed confirms a cut and risk assets globally breed a sign of relief, crypto could get a bounce. But the real test is whether it can hold those gains in the face of continued selling from longer term holders who just want to de risk. All of that sets up for the anchor team of the coming week. Is this December rate cut, if it comes, going to feel like a cushion or a confession? On the bullish side, the argument is fairly straightforward. Labor market indicators have softened. Slower job growth, a higher unemployment rate, and growing concerns about job prospects, which Capital Economics underscored through the University of Michigan Index. It just dropped to a 3-year low, weighed down by government shutdown and lingering inflation worries. Inflation itself has moderated from its peaks. Financial conditions are still tight enough to bite, even. Um, in that framework, a 25 basis point cut is a reasonable step to prevent a hard landing and keep credit conditions from deteriorating any further.
Tina, on the bearish side, there's a more uncomfortable reading, right? If consumer confidence is tumbling if inflation expectations are stuck near the 4.8%, and if safe havens like gold are moving because people don't trust the future, then a cut can easily be read as the Fed admitting that something is already broken. And that's before you considered some sentiment measures like the Michigan index, for example, are back to levels that were last seen back in 2022 when inflation and growth fears were at its absolute peak. Biggest uncertainty isn't actually the cut itself, is what I believe. It's what happens if the Fed surprises by not cutting at all or by signaling that this is a one and done move. Markets have emotionally priced in not just the December cut, but the idea that this is the start of a gentle easing cycle. If the Fed pushes back against that narrative, the adjustments in bonds, equities, and even crypto would be sharper than anything the data alone would justify.
Before we close, let's step away from the Fed for a moment and look at one surprising fact that quietly changes how you think about global demand: China's industrial profits. In October, industrial profits in China fell about 5.5% from a year earlier, the worst performance in 5 months, according to reporting cited by CNBC. Behind that headline, Nomura's economists estimate that roughly 40% of China's core inflation is being driven not by local consumption, but by global gold prices filtering through. In other words, one of the world's biggest economies is seeing its inflation data shaped significantly by a global rush into safe havens rather than by people spending more at home.
You know, Tina, that detail really tied the whole week together for me. When China's inflation is driven more by global sentiment than its own consumption, the mood isn't local anymore, it's global. Last week felt like a thoughtful caution. Everyone moving, everyone attentive, but with slightly more restraint. And heading into next week, I'd say the mood is alert. People aren't looking for action exactly. They're listening for tone. They want to hear if the Fed speaks with confidence or carefulness. That difference will shape everything, honestly.
You know what? You've summarized the mood of the coming week perfectly, Kaustav. It's one of two things. It's either confidence or carefulness. The tone will define what the week's going to look like. And that brings the close to this episode of the Weekly Pulse by Sentiment. Have a great weekend. And here's to a week where the noise quiets down and the mood of the markets make more sense.
And heading into next week, I'd say the mood is alert, right? From everything that you've told me right now, Dina. People aren't looking for action, they're listening for tone. They want to hear if the Fed speaks with confidence or carefulness. That difference will shape everything.